Welcome back to Morning Trade Live. It's time to go inside out. Joining me right now, Ken Leon, Global Director, Industry and Equity Research at CFRA. Thank you so much for being with us. I know you have specific calls on the different banks. A lot of folks looking forward to this earnings season. There's been a lot of trading, maybe trading revenue may be higher. Is that one of the themes? I mean, what are you looking for as far as themes or what you want to hear from the banks in particular? I mean, it could be net interest income. It could be credit quality. I mean, maybe M&A activity. I don't know. What are you watching for specifically as far as trends?
No, it's great to be here. And, what a difference a quarter makes. Back in April, there were dark clouds, not only for banks, but also for the economy and the market. So to your point, Nicole, on the checklist of the key drivers, obviously you want to see the body language or messaging from these managements that have a front row seat to the global, but also Main Street U.S. economy, consumer and small business. Of course, that would be the tariff risk. Capital markets expected to be two things. One, showed vast improvement, particularly in May into June. And then again, what managements have to say for the second half outlook, we think it's going to be very positive. Third would be rates and its impact on both their customers, as well as something called net interest income, which is it's a big revenue item for them. Rates, policy, and the Fed also plays into this. Put it all together, we have an overweighting on the financial sector and the large banks. Many of them are part of the top 10 constituents. And also, I think, while some of the analysts who cover banks might become more conservative on valuation, I think they're very much in a silo, just looking at price to book value. When we look at earnings, many of these large banks, we reiterated our ratings and raised our target prices back in late June.
What in the capital markets, the vast improvement from May to June, what do you think is the driver of that, and does that continue?
Yeah, and there's really, three buckets, if you will. One that's had, record results, which we already knew, was the debt capital markets. The second would be the equity capital markets, where we began to see IPOs begin to show life. First, it was happening, as I'm a global research director, over in Hong Kong, and then it began to spill over to London, but also New York. And we did see here not a large size in terms of issuances, but some fairly large, high-profile deals. That will be what we hear from the managements on the pipeline, should be very good. Last is mergers and acquisitions, which again began to pick up in the second quarter and into June itself. And that was coming mostly from corporates. But what we have, and I cover the largest private equity firms, they have a backlog of $2 trillion of companies owned. Either they got to go with M&A, go public, or do sponsor secondary financings. All of the above becomes, for the large global investment banks, investment banking fees. That's our thesis for a very strong second half outlook and then into 2026.
Can you view the backlog of $2 trillion of those companies own that they have to do something with? I mean, it seems like they want to do a lot of action. There's a lot of money on the sidelines, and that seems like good and good. At the same time, if they start selling these things off or getting them acquired at instead of a takeover, a take under, could it be a downside? Is there a downside risk in this? Is it more of an upside story or more downside risk?
Yeah, it's a great question. And well, first of all, we're not in a risk on environment. We're coming out of a risk off. Also, when we look at the magnitude of the exit ramp from these private equity funds, whether it's 5-7 years, they need to do something. But the size overall is enormous. The Wall Street Journal had an article today just talking about clever ways that private equity firms can sell to others or put it out to institutions. But some of that is going to come to the public markets. That's important, and we'll just have to see. But that's a key point, because if you're positive on the large banks, you're positive on the capital markets for the second half of this year. We are. And of course, trading with volatility.
For Goldman Sachs, you have a strong buy, Citi, you have a buy. Those two seem to be standouts. Bank of America, you have a hold, which I'll get to in a second. What are Goldman Sachs and Citi doing right that you have strong buy and buy?
A little bit different stories, and just picking up from your last story with the downgrade by an analyst, Goldman Sachs has increasing durable recurring revenue fees from asset and wealth management, sizable businesses. We're also seeing them take wallet share even in the second quarter in investment banking, and then my thesis of a strong second half outlook. On valuation, we back on June 28th raised Goldman. It's a strong buy rating. We have a 740 target. That's about 14.8 times next year's earnings. The 5-year is 14.9. And again, about this overweighting on the financial sector and bringing it down to Goldman, the S&P 500 next year is trading at 22 times earnings.
And then for Citi, you have a $93 target and a buy rating, right? And then Bank of America, you have a hold and a 47. Tell me some of the differences there.
Yeah, quickly there, Citi, we're almost finishing the first or second chapter of restructuring. It's getting closer to book value. Still the only bank that trades at a discount to book value, and essentially their ability to execute in areas that are really inside the bank on efficiencies. Bank of America, we did downgrade Bank of America. We have a hold rating several weeks ago, maybe a little bit early, but the thought there is that the delta for both fundamentals or earnings and then the stock would be less for Bank of America because it's so broad-based with Main Street economy, small business, consumers, et cetera. Bank's fine. Brian Moynihan, CEO, he's exactly going to talk about what I just said. We watch credit risk very closely. We're still in the green zone, if you will, of what the delinquencies and all the metrics of credits, nowhere near any concerns on credit risk.
Yeah, understood. JPMorgan, I'm not sure if you cover JPMorgan, but everybody always says that's a darling. We're not talking about that one. Tell me why. Tell me a little bit about that name.
Yeah, we have a hold rating. It's been a buy for a long time. I wish I had that one back from a few weeks ago. Essentially, it was kind of a blend of our bull case for the capital markets, but a little more concerned about slowing Main Street economy. In the case of JPMorgan, stock has done well. We did raise our target a few weeks ago, 295, I think, and we'll just have to see how much of an outsized contribution comes from the bigger growth areas for the bank, which is the capital markets.
Right, understood. When we think about the rate environment and tariffs, are we worried that that sort of detours your strong buys and buys? I mean, are these pretty foolproof at this point and you buy on dips on a name like Goldman Sachs?
Well, nothing is foolproof, and actually it leads, with the question of the tariffs of uncertainty and what corporates or CEOs or CFOs want to do, either with their business plan or capital investment. That, of course, feeds into capital raising. So the CEO confidence measures are important. What we will hear on the call perhaps is an update on what they're hearing from their leading corporates. Many of them are multinationals, so tariffs play into that. I think with rates, having rates where whether we think there'll be 4 rate cuts in the next 12 months means that the trajectory of net interest growth, net interest income for the banks will be less. We look at really mundane things like net interest margins, NIMs, and a lot of other stuff. That's why it puts some downward pressure on those exposed to the traditional banking like JPMorgan and Bank of America.
Right. Ken, it's great to see you. Ken Leon, Global Director, Industry and Equity Research at CFRA. Thank you so much, Ken Leon. Tom White is with us, host of Fast Market. Interesting, he had a couple of holds, and we're looking at Bank of America and JPMorgan, both of which he had hold ratings. You have an example trade for Bank of America. Tell me more about this name.
Yeah, Nicole, they've got a $47 price target. They're neutral on it or hold on this stock. It's been pretty spectacular run that we've had. Shares are up about 6% this year, but far off of those April lows, like every other stock in the S&P 500. The option market's priced in about a plus or minus $2 move either way. That's about 4% in the shares. So going with Ken's price target here, I just created a strategy that creates yield. It's a paid-to-wait type strategy. So I looked at a covered call in here. Maybe you want to own the shares. You want to collect that 2.2% dividend yield. This allows you to do it. For every 100 shares of stock you buy, you sell an out-of-the-money call. Implied volatility levels still muted, but kind of elevated going into this report. So you're going to collect a little bit more option premium on those out-of-the-money calls. So for every 100 shares of stock you buy, I looked at selling the August 1st weekly, the 48 strike call on those. You're going to pay roughly just under a $46 debit on that. So that's going to also be your break even on it. So you've got over 1.5% to that break even. So you're buying the shares at a discount because you're selling the 48 strike call against it. And then over the next 2.5 weeks, as you get closer to August 1st weekly expiration, you'll have that opportunity to roll or adjust that short call, and that collects credits, right? And that takes down your break even, increases potential profitability on this one. But creating yield by owning the stock, collecting the dividend, and then also selling out of the money calls against that. It's relatively a conservative, neutral strategy, but allows you to collect that yield.
Okay, and then what about JPMorgan? Let's look at JPMorgan as well. It's going to be such a busy week for all these banks.
Yeah, this stock just off all those all-time highs on the nearly 20% rally that we've seen so far this year, getting extended. We've seen some upgrades, some downgrades recently on this name. I know that Ken and CFRA is relatively neutral on this one. So looked at another strategy that's relatively neutral in here, a short iron condor in really near-term positioning on July 18th. Monthly options that expire this Friday. So just 4 days to expiration. It's an earnings type of strategy here where I'm going to sell something at the money, basically the 290 strike call and put. You sell each one of those, and then to make it risk defined, we're going to buy on the downside the 275 strike put, and on the upside buy the 305 strike call. So in essence, you're selling a straddle at the 290 strike in July 18th options, and then buying a strangle, the 275 and 305 put and call there. So it's a short iron butterfly, we sometimes call this, because we have that same strike that we sell the options on the call and put on the 290 strike. You're going to collect roughly about a $9 credit on it. That's what you can potentially make, and you can see here from the risk profile, takes my break evens down to 281 on the downside and 299 on the upside. So you're taking advantage of that higher implied volatility on this one. You've got a wide, area where you're going to be profitable on this one. You just don't want it to go below 275 or below a 305. That's where you're going to see max loss on this of about $600 either way. On this strategy, but relatively neutral. You just need some consolidation post earnings in this one, and time decay or positive theta is in your favor. So this, the price of this this strategy will decrease on a daily basis into expiration.
All right, Tom White, great to see you. And we'll have these banks, right? We have JPMorgan, Wells Fargo, Citi, and BlackRock tomorrow, and a lot to watch when it comes to these banks this week. It's good to see you, Tom White. Thank you.